each one of you to today's interesting session on the country by country reporting proposals of budget 2016. Finally, the country by country reporting requirements have reached Indian shores, and it is possibly the first time in the history of the world that emerging economies and developed economies are looking at implementing the same regulations to enhance transparency. So if we now move to page 2 of the presentation, it shows today's agenda. We are going to very broadly look at what was Action Plan 13 of BEPS and what are the Budget 2016 proposals. And we are also going to look at how other countries in the world have implemented these proposals. So we move to page 3 now, where we have broadly discussed and captured the key requirements and the key recommendations of Action Plan 13. And why does it matter? I think it is the first time in the history of the world, and very well now a requirement for Indian multinational companies and foreign headquartered companies operating in India, that large amounts of previously possibly undisclosed data is going to be made available to tax authorities consistently and in the same fashion, in the same format, and in the same manner to all the tax authorities in different parts of the world, including India. Broadly, the Action Plan 13, which was to promote transparency, was designed to increase the transparency by providing tax authorities with sufficient information to allow them to conduct transfer pricing assessments and to consider, more importantly, whether the groups are engaged in any kind of BEPS, which is base erosion and profit shifting type activities. And to address this and to provide an identical information to everyone and not really one side of the story, the proposal and the recommendation was to have a three-tiered approach in documentation of transfer pricing. First, there should be a master file capturing the high-level information about the MNC's business, policies, agreements, etc. Then there should be a local file capturing the relevant intercompany and interjurisdiction transactions covering the payments, receipts for products, services, royalties, interest, etc. And more importantly, there will be a requirement to have a country by country report giving high level information about various jurisdictions where the multinational is operating, the various kind of revenues from related party, unrelated party, number of employees in each jurisdiction, and assets, and so on. So with this background and India being an active participant in this entire BEPS journey, and India being very actively wanting transparency and a fair allocation of taxes to the jurisdiction where the economic activities take place, India had agreed to this proposition, and therefore, as it was expected, the budget 2016 provisions do contain now a mandatory requirement for Indian multinationals and in certain cases foreign multinationals to follow up and file a country by country report. So let's look at what these requirements are. On page 4, the key proposals have been listed out. First of all, someone may ask why. What is the requirement of these proposals? It is clearly to provide Indian tax administration with the useful information to assess transfer pricing risk. It is to facilitate the transfer pricing administration, which is already understaffed, to make determinations about where their resources should be deployed more effectively and efficiently. I think this is a good step. By when these requirements will trigger in, I think the budget is making it very clear that these requirements will be applicable from 1st April 2016. So the first year for which it will be applicable is financial year 2016-17. And it will be applicable for country by country report only in case of groups whose consolidated revenues exceed euro 750 million, which is approximately 5,000 crore plus. And to be specific, for this threshold, the conversion of 750 million will happen as on the last day of the previous year. So for example, as on 31st March 2017, whichever groups consolidated turnover exceeds euro 750 million will be required to file a country by country report. Now, what is the requirement? It is very clear. Section 92D and Section 286. Section 92D 1 proviso mentions that a master file will be required to be filed. Section 286 requires that a country by country report will have to be filed. And of course, the next steps will be to really look at detailed rules around what should be contained in master file, what should be contained in country by country report. But in principle, the finance minister has clarified in speech that it will be in the lines of the BEPS OECD recommendations. So we move to next page, page 5. On this page, for the country by country report, the summary of what is to be filed, who has to file, and by when it has to be filed is covered. Regarding filing of country by country report in India, for every reporting accounting year, the Indian resident entity, which is a parent entity, has to make this filing by the due date of filing return of income under Section 139. Even in certain cases where the Indian resident is not the parent entity of the group, an alternate reporting entity, if it is a resident in India, will have to make a filing. For example, if there is a multinational group which is headquartered outside India, but it decides to appoint its Indian company as an alternate reporting entity for the purposes of country by country report, it is this alternate reporting entity which will have to file this CBC report with the Indian tax authorities. Also, there are certain cases, special cases, where the Indian entity, which is not the parent entity and which is not the alternate reporting entity, will have to make the filings, because in cases where India does not have an agreement for exchange of report with a country of parent entity, or the said parent entity country is not wanting to share the information under automatic exchange, which means there is a systematic failure on part of the country or territory to automatically exchange the country by country report, and the Indian constituent entity is notified of this failure, the Indian constituent entity will have to make a filing in India. So to give you an example, let's say there is a UK parent and an Indian subsidiary. In normal situation, the Indian subsidiary will not have to file the country by country report in India because the parent is the UK company. But for some reasons, hypothetically, if UK does not share the information and if there is a systematic failure in sharing the information, then the Indian tax authorities can notify the Indian subsidiary of the UK company that there is a systematic failure, and accordingly the Indian company in such situation will have to make the filing of country by country report with India. Now, of course, the question will arise where the parent entity or the alternate reporting entity is not an Indian resident entity and therefore is not required to file country by country report in India. How will the Indian tax authorities get access to this country by country report? So, for example, if there is a US headquartered multinational organization having presence in many countries, including India, how will Indian tax authorities get the access to this country by country report? It will be clearly through the exchange information automatically under various treaties and various exchange information mechanisms which are already agreed. So now we move to the next slide, which is page 6 of the presentation, where some of the terms have been defined in section 286, namely what is the group. I think first of all, for the requirement of country by country filing to trigger, there should be an international group. International group will mean where there are two or more enterprises which are resident in different countries, and there are different entities, for example, incorporated in different countries, and there are permanent establishments in different countries. So to give an example, if there is an Indian company, it does not have any presence in any part of the world by way of subsidiaries. But if there is a permanent establishment, for example, let's say in South Africa, still it will be regarded as an international group. Similarly, question may arise, what is a parent entity? They have the provisions defined it very clearly. The entity of the group which holds directly or indirectly an interest in other entities, and it is required to consolidate such interest, assuming that the shares would have been listed on the stock exchange under the consolidation rules. In such a situation, the entity which is required to consolidate will be regarded as the parent entity, and the rest of the entities will be regarded as the constituent entities. So we move to the next slide, which is slide 7, to kind of look at what the table is of country by country reporting requirements. It is identical, thankfully, to the BEPS recommendations. So there is no distinction envisaged between the reporting requirements in India vis-a-vis the reporting requirements recommended in BEPS Action Plan 13. So the requirements will be clearly to identify the revenues from unrelated party, related party, profit before tax, cash tax paid, current year tax paid, the stated capital, accumulated earnings, tangible and other assets. More importantly, the number of employees. So, for example, this sheet will clearly throw up if a multinational group has income from 5 countries, 5 jurisdictions, and has, let's say, 99% of his employees in country A, B, C, D, but only, let's say, 1% of the employees in country E. But however, if there is a disproportionate amount of profit which is getting booked in that country E, which has just 1% of the employees, it may or may not satisfy the arm's length principle. However, it can definitely lead to an inquiry from a tax authority. Similarly, the table also mentions clearly to identify what the role of that entity is, whether it is a holding company, whether it is a procurement company, and so on. I will not spend much time on this because this is identical to the BEPS requirement. Moving on to page 8. The format of master file is not prescribed in the act, but it is going to be prescribed in the rules. However, we expect, and I think the finance minister has made it clear that the requirements in India will be identical to the suggestions under the Action Plan 13. And therefore, all the details around structure of the company, the group, the business drivers of profit, overall strategy description, financial arrangements, annual consolidated statements, and lot of details around intangible properties and advance pricing agreements signed will have to be given in the master file. Okay, so after having looked at it, let's move to page 9. On page 9, there is a summary given of ultimately what budget 2016 requires in terms of notification and filing. For inbound multinational companies, means the foreign headquartered multinational companies having operations in India by way of subsidiaries or permanent establishment, there will be a requirement to upfront notify the tax authorities on the point as to whether it is an alternate reporting entity, because if it's an alternate reporting entity for the group, then it will have to make the filing in the Indian tax authorities of the CBCR. Also, if it is not the alternate reporting entity, still it will have to notify the Indian tax authorities about the details of the parent entity or any other alternate reporting entity and the country in which the parent entity or the alternate reporting entity is situated, so that India can ask for the country by country report from that country. This is the first one-time upfront requirement. Every year, annual requirements will be to file the master file directly with the Indian authorities, to file the local file, which anyway happens today with the Indian authorities, and to file the country by country report directly with the Indian authorities in certain cases where it is notified that the exchange mechanism has failed with the country of parent entity or with the country of ARE entity, or where it is itself the ARE entity. In case of outbound MNCs, which means the Indian headquartered multinational companies, there will be an annual requirement to file the country by country report, master file, and the local file. So now, having known the precise requirements under budget 2016, let us move to page 10, where the details around the possible issues which can arise for Indian multinational companies which have gone outbound. For example, a Tata Group, Godrej Group, Birla Group, lot of pharma companies have gone outbound and have presence in multiple jurisdictions. Lot of queries can arise, lot of issues can arise, lot of procedural challenges can come as they start preparing a country by country report. For example, do they already have a software or a database to automatically capture the data required to be filled in the report? How the data will be mapped? Who will be in charge? Whether they need to ramp up their tax departments to be able to capture this data, whether they need to amend their softwares and accounting packages to capture this data. How will they ensure that this data is captured consistently and in a meaningful manner, and how they will ensure that the whole process is sustainable, because this is not a one-time requirement, it is an annual requirement. The bigger risk from a strategic perspective will be to examine if there is a high risk or high degree of scrutiny likely because of this country by country report on procurement models, on supply chain models, on holding company structures, on various other financing arrangements, because all the data will be shared in one single table in one single format with the Indian tax authorities, and also with each and every tax authority in the world where they are operating. The issues around accounting for seconded employees, joint ventures, will arise because whether they should be consolidated, they should not be consolidated. However, I'm hoping that the rules and the clarifications will be made where all these aspects will be clarified by the CBDT. One another challenge which comes for Indian headquartered companies is to continuously track which are those countries where Action Plan 13 of BEPS is implemented and which are those countries where it is not implemented out of the countries in which they are operating, to ensure that they don't avoid a mismatch, that they avoid kind of ensure that consistency is maintained and there is no non-compliance. Similarly, on next slide, we have listed down the possible issues, and we will be discussing the possible issues which could arise for foreign headquartered companies operating in India. Clearly, they are already under scrutiny, and with this, there is a likelihood that there will be high degree of scrutiny by the Indian tax authorities, Indian transfer pricing authorities, because there will be an end-to-end transparency in respect of revenue and profit allocation. There will be enhanced risk of an attempt made by transfer pricing authorities in certain cases for applying profit split method instead of a cup, or instead of any other traditional method of TNMM, or maybe resale price method or cost plus method. And therefore, it will be extremely important to see where India fits in the entire value chain, and looking at only one side of the story from an Indian perspective may not be enough. One will have to really look at the entire end-to-end value chain to be sure that India is appropriately remunerated at arm's length for its risk and functions and activities and assets. Also, the Indian tax authorities will come to know about advanced pricing agreements signed by the taxpayer group in different countries, and the impact of that will have to be analyzed by the MNC group, so that the Indian tax authorities are given appropriate explanation in case there is a distinct or a different transfer pricing mechanism followed for India. I think, having looked at the issue, let me show you a graph which will very easily on the next slide bring out what the challenge and how acute the challenge can be in certain cases, especially around intangibles. This is a case study where there is a global IP owner which has given the regional principal the IP and charges royalty for that, and the regional principal or the licensee has in turn given the goods, or it sells the goods under that IP to local distributor entities, for example, let's say in India. And because of the distribution function, let's say the arm's length determined for local distributor is 10% of the system profit. However, because of the intellectual properties involved, 50% of the system profits reside with the regional principal, and 40% of the entire system profits, which are the balance profits, reside with the global IP owner. Today, the Indian tax authorities generally have visibility only on the 10% of profits getting taxed in India in the hands of local distributor, and the 50% of system profits getting paid to regional principal, because the payment is happening from India to regional principal. The remaining transactions are clearly not visible to Indian tax and transfer pricing authorities. Going forward, the entire value chain will be visible, and the Indian tax authorities may very well ask not only why 50% of the system profit is lying with regional principal, but they may very well ask why 90% of the profits of the system is lying outside India. And there may be justifiable reasons, but I think the multinational companies will have to examine and strengthen their documentation, strengthen their substance in each of the entities to be able to demonstrate what they are doing and the transfer pricing that they are following. Having said this, let's move to the next slide, which is on page 13. This gives you an idea of the severe penal provisions for failure to furnish the master file, which is 5 lakh rupees, failure to furnish accurate particulars or furnishing inaccurate particulars, again the penalty is 5 lakh rupees. Similarly, if the country by country report is not filed, it is not a static penalty, but it is a per day penalty starting from 5,000 per day to 15,000 per day. And if even after passing the penalty order, information is not shared and default continues, the penalty can be as high as rupees 50,000 per day. Similarly, the Indian tax authorities have got a power under the Act to actually request for further information based on CBC are received. And if there is a failure on the part of the entity to provide further information and further responses to the queries raised, there can be a penalty of 5,000 rupees per day. And if after serving the penalty order, the default continues, the penalty will be 50,000 rupees per day. So there is enough deterrence to ensure there is proper compliance. In light of this, let's look at where does India fit in and where the whole BEPS Action Plan 13 implementation globally has progressed. As far as master file is concerned, there is a lot of progress. A lot of countries like Mexico, Norway, Denmark, Netherlands, Finland, Spain, Australia, China, Korea, they have already either implemented or are in the process of implementing the master file requirements. Similarly, on next slide, if you go to page 15, around 16 countries have already introduced proposals in their local regulations to implement the country by country reporting. I think this is clearly becoming a norm of the day, and I think more and more countries are wanting to implement this requirement. In fact, European Union has already introduced draft anti-BEPS directives and anti-avoidance package, which contains the country by country report, and EU countries will have to give effect to this directive by introducing the country by country report in their local legislations. As recently as 27th January 2016, 31 countries have signed multilateral competent authority agreements on the exchange of country by country report, and United States has also proposed the country by country regulations, but it has still not signed the multilateral competent authority agreement. In my view, on signing of this multilateral competent authority agreement, this itself can act as a channel for exchanging the information on an automatic basis for Indian tax purposes as well, if India also decides to sign this multilateral competent authority agreement. If now I were to take a deep dive into what kind of proposals have been made by different countries which have implemented country by country report, what I can see on page 16 and 17 is that most of the countries have decided to keep lot of requirements identical to the OECD BEPS requirements. For example, on the timing and on the secondary filing rule, we find that Australia, Denmark, France, European Union, they all have kept the requirements identical to OECD. So there is a lot of consistency on that part. But a real difficulty or a challenge is likely to arise for a multinational group when some of the other requirements, like the turnover criteria for triggering the requirement, for example, as to who is required to file, and the timing when it can get applicable, the initial whole transition phase. I think these are the areas where multinational companies will take some time to adopt, and to ensure that they are compliant in all the countries. They'll have to really in detail study precisely what is the status of the proposal in each country, what is the requirement precisely, what are the penalties involved if the requirements are not satisfied. And as you can see on page 17 and 18, the countries like Ireland, Italy, Japan, Mexico, Norway, Poland, and all United States, United Kingdom have all actually already introduced or either a draft law or a final law for country by country. So I think I would like to end this session by kind of suggesting, based on our experience in various cases where we have already got involved, to do a dry run on how the country by country report could look like and how the requirements of master file, local file can be satisfied. I would only like to share my views that it is not one more mere formality to be done. Lot of risk-based analysis will have to be done once the data is captured in this kind of format. It may result in structuring or restructuring the existing global supply chain structures, global financing structures, and it may also throw up certain other BEPS risk under other action plans, be it under the treaty for permanent establishment, be it under action plan 8 to 10 for other transfer pricing risk. Hence, my experience and my view would be to really undertake a detailed analysis, a risk-based BEPS analysis based on this country-by-country report data which gets thrown up, and as a second step to ensure that enough systems are already in place so that this whole requirement and the collection of data becomes sustainable and becomes on an automatic basis, so that the cost of compliance is reduced to the extent it can. With that, I would like to end this session, and I would like to thank you for your patience to hear me out. And I would invite your views and suggestions and thoughts on my email address, which is paresh.parekh@in.ey.com. To repeat, PARESH Paresh.PAREKH Parekh @in.ey.com. Thank you. Have a great day.